Morning, market chameleons, and there's my video is not showing. How's everyone doing this morning? How you doing, Dima?
Good morning, Will. How are you?
Awesome. It's going to be an exciting day. I've got CNBC over my shoulder on mute. Bezos is about to go into space, which is interesting.
Oh, very cool. Today?
Yeah, today. It's within 15 minutes. So in the middle of the show, he will launch into space.
Okay. And what did they have, like live footage from?
Yeah, they have a live feed. They have a live feed from the spacecraft. They have people on the ground. I mean, it's
Wow, that's exciting.
It's a pretty exciting day because he's a man who made his fortune over the last 20 years, and now he's going into space, which is pretty cool.
Wow, that's awesome.
All right, before we get started, let's do the disclaimer. What do you think?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
Excellent. So what's untapped for today with the chameleon?
So I think we'll go over ETF fundamentals, and kind of like talk about a couple use cases for it. Okay, so before we get to that, let's take a look at the pre-market report, see what's moving in pre-market hours. If there are no questions, I'm going to hop on to the ETFs. So these are stocks trading in a pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Coming down here, and I see that 145 stocks made our percentage gainers list, 32 on the percentage decliners list. So from that perspective, looks like a more bullish bias at the opening. I'm going to use this market cap filter and see what's going on in the higher market cap stocks. See if there's a similar situation there. So market caps 20 billion or higher, and I see 32 made the percentage gainers list, 6 on the percentage decliners list. Again, from that perspective, looks like a more bullish bias at the open. If we don't have any questions on this, Will, then I'm going to jump to the ETFs.
Yeah, jump on.
All right, I'm going to use, I think, SPY ETF, the S&P 500 ETF as an example here. And I'm going to jump in SPY, take a look at ETF financials. And before I go over it, kind of what I want to do is just describe what we're doing here. And when in ETFs, it's a grouping of stocks, right? So in the ETF, they have holdings, and those holdings basically have different weightings. And then if you take those holdings, you create a net asset value, and that's what makes up the ETF. Okay, so it's kind of like a benchmark of something, right? So SPY, it's the S&P 500 benchmark, 500 biggest companies listed. QQQ, 100 of the biggest technology companies. And then you could have other ETFs, which are just sector-based, that, like, for example, in the SPY, you have different sectors. You'll have like financial sector, you'll have consumer cyclicals and all that. So then you have ETFs that have those types of holdings, and that makes it useful not only because you can invest in it, you can invest in the sector, you can invest in the S&P 500, but we could use that as certain benchmarks for ourselves, and we could use those benchmarks then to evaluate other types of investments. All right. And I'll give you maybe just some analogies before we get into the financials and why we're kind of looking at them. Let's assume you are out there and you're trying to invest in a rental property. So if you're investing in a rental property, you kind of want to know, well, before I invest in it, am I getting a good deal? Is it not a good deal? Is there certain edge in this investment? And what you might do is you might start referencing different industry benchmarks. Okay, now, for example, let's just say you ask your broker, well, in this area, what is the average rental for a 3-bedroom apartment. Okay. And he might say, well, $10,000 per year. Okay. And say, okay. And for those same properties, what is the average selling price? And let's say he says it's $100,000. Well, based on those benchmarks, you could say, okay, well, $10,000 in rental income, $100,000 purchasing price. Well, that's 10%. So my cap rate is 10%, right? Or you could do it the other way, like we do in industry PE ratios. You could say, well, $10,000 in rental income. If I'm paying $100,000, I'm paying 10 times my annual rental income. So now you have this benchmark, and you could use it as a starting point for your research, because you could say, okay, well, here's a property, and let's say this property is 20%. You're making 20% cap rate, right? You're buying it for $100,000, but you get $20,000 in income. Well, that could seem like a good deal, right? Because you're already beating a benchmark. And the idea behind it is, well, if you're beating a benchmark, then you have a little bit of a cushion, because if your property converges to the benchmark, then you're like making this extra, right? You have like this extra cushion that exists there. But you also want to take a look. Now that's keeping all things equal, right? So that's your initial kind of valuation to see like, well, what's going on here? And let's say you discover all of a sudden, yeah, I'm getting this 20% cap rate, but the property has issues. I have to make repairs, and maybe there's some taxes owed on it. There's some problems. So then you have to take the cost of that and say, well, if I include the cost of that to get it up to par, what is the cap rate afterwards, right? So I'm buying it at $100,000, but maybe if I have to spend another $100,000 to get it up to par, then you're back at that 10%. So it might not be a great deal. Who needs that headache? You stick with your, with the benchmark, because it's more diversified investment. Or there might be, maybe you decide, well, you know what? Yeah, there's problems, but it'll only cost me maybe, $50,000. So I'm still getting a higher cap rate. So that's one way. Or it could go in reverse. Maybe you see, hey, you know what? Here's a property. It's interesting, and the cap rate's 5%. So based on my benchmark, I am overpaying. But you look closer and you say, well, wait a minute. There's this. I'm overpaying, but it has this huge property, right? That I don't need. If I subdivide it and I sell off, this empty lot that I have, and just keep my rental property, after I sell it off, pay myself back, I'm actually, my new cost basis is much lower, and I'm making now a 15% cap rate. So when I talk about benchmarks, you kind of want to sometimes use it saying, well, maybe there's an opportunity. Let me take a look at it, keeping all things equal. But then you do want to go look deeper, because there always could be some reason for this why it's priced away. So just to set this up, right? That's why we use benchmarks, and you'll see a lot of it. Just, I don't know if people are in the real estate industry, but you'll see medium prices of homes nationwide, medium prices of homes in local areas, in states, and medium rentals. All these are benchmarks used by investors so they could get a sense of, am I getting a good deal, not a good deal? Okay. So in the ETF space, we could use them also as benchmarks to evaluate other investments. So one way is in the S&P. If we take the SPY and we say, okay, we know that each stock has we could put a valuation on it, PE ratio, price to sales, and we're going to go over it. So why don't we create a PE ratio for the S&P 500? And this way we could use that as a benchmark to see, well, if I invest in stocks, outside of the S&P 500, am I doing better or worse? Because why would I want to invest in a stock, in an individual stock, instead of just using the S&P 500? Okay, so you would need that extra, right? You would need that extra alpha or that extra edge. So let's take a look at some of the fundamentals. So how do we calculate these fundamentals, right? So how do we calculate a PE ratio for the S&P 500? Because SPY itself is not a company, right? It's a ETF that has holdings for other companies. So we'd have to come up with a kind of theoretical PE ratio, right? So what we do is we'll say, okay, well, if we take the holdings, right, and for each holding, there's an earnings, right? So if S&P 500 holds X amount of Apple computer stock, well, how much earnings am I getting from those shares? And you do that for all of them, right? And then you say, okay, well, if I'm holding, all this stock that I'm holding in the S&P 500, this is how much earnings I'm entitled to for each share. So now you got a bunch of earnings, right? And then you figure out, well, what is the market cap of all those shares? So if I bought all those shares, how much am I paying total? And then you divide it by the total amount of earnings, and then you get a PE ratio. All right, so that's what this PE ratio is, 32.2. Now, just one caveat here. When we're looking at an ETF S&P 500, there are 500 companies. Sometimes some of those companies, we don't have enough data. Okay, maybe they weren't there because we look at like 5 years history. If they weren't there for 5 years, or they had some funky data or something, what we do is just exclude those out of it. So you might get, if I'm going to come down here, for example, here are all the S&P 500 companies. We highlighted the ones we excluded in orange. So these are just not even included in there. So you'll get a PE ratio. You'll still get a PE ratio, that's close. It's just not going to have all the 500 companies potentially if there's not enough data. Okay. So here we're seeing, that if we take the S&P 500, now we have a PE ratio. So if we bought all the stock divided by all the earnings we get a PE ratio. And the idea here is like we treat it as one company. Okay. So think of Facebook, it's one company, but it could be made up of different companies within Facebook, right? Because they have Instagram and whatever. Google is also made up of different companies. They have YouTube and all these other companies, and then you just kind of like consolidated all of them into one. So that's the idea here. Well, we basically own the S&P 500. So now I got a PE ratio of 32.29. And then I could start using that as a benchmark against other companies. We could also use it as a benchmark against itself, and we could just see how the current PE ratio is doing versus its historicals. So we could see here that on a 3-year average, the PE ratio is 25.42, 5-year average 24.55. So we see here that currently the valuation, the prices people are paying for the stocks relative to the earnings, the trailing 12 months of earnings, is higher, right, than its historical average. And one reason we have to look for justifications, but one of the justifications is that, well, because of the coronavirus, we're government's heavily stimulating. We have 0% interest rates. Monetary policy is pretty loose right now. We also have another stimulus package coming. So the markets are giving future growth, right? They're pricing that into future growth. All right. But similarly in real estate, they'll talk about median home prices have increased, over the years, maybe the fastest increase in like 10 years, but that's how we're using this benchmark in a similar situation. Now, so that's price over earnings. We could also take a look at price over sales. So that's if we took the entire market cap and divided by the total sales or revenue. So we're seeing that right now it's 3.16 times its total revenue. Again, that's higher than the 3-year and 5-year average, and mostly due to that stimulus. And we could see, well, by how much is it? So we see that it's higher. So we could use a standard deviation, right, to see how much higher it is. So what is this telling us here? So of course, the prices, when we're looking at averages, right, the prices are still fluctuating, right? So you might have a valuation 24, 25, 26, back to 25, 24. So it's going to be in a range. So a one standard deviation up or down is really the expected range. Okay. So when we talk about a standard deviation, once you get above a standard deviation or below a standard deviation, that's when it's starting to come out of an expected range. So right now we're on the PE ratio, we're 1.1 above. So close. So I think it's close enough. On a 5-year basis, 1.6 enough. So a little bit elevated, but we do looking at the data surrounding information, it might be justified just because forward looking, we might see faster growth because of the stimulus packages that we're getting from the Fed and from the federal government. Price to sales, that's 2.7%, and this is 3.4 standard deviation. So that's on the high end, right? So that's pretty high. In other words, we're seeing that sales have to really accelerate, and if they don't, then there's a lot of room to come back if we revert to that mean. All right. So those are some of the ways looking at the numbers. And right now, I'm just comparing SPY to itself. I'm not looking at a different stock. Okay. Price to cash, kind of the same idea. If we take the cash on the books versus its valuations, 8.68. So here, this is a little bit lower. This is telling me that there's actually more cash on the books right now relative to the valuations, okay, than before. So cash-wise, S&P 500 looks pretty good, right? They have a lot of cash sitting there. Maybe it's easier to raise now. They could issue more stock, maybe even issue bonds at cheaper rates. So they do have, looks like pretty good cash reserves. Price to book value, this is if we compared it to the breakup value, right? What's book value? It's if you took the total assets and said, I'm selling all the assets that I have, paying off all the debt, what's left over, that's the book value. That's theoretical, what they report on their the SEC filings. That's 15 times. Right now we're 15 times book value, and you could see that that's almost 3 standard deviations above historicals. So I'm just going to kind of go over these today. Maybe tomorrow I'll take it a little bit further and start comparing it to an individual stock. Price to EBITDA, that's earnings before interest and taxes. It's another way of looking at earnings, but you don't include, you don't deduct the interest and taxes out of it. You just want to take a look at, how much is it because theoretically, if you sold off your assets, paid off your debt, how much earnings do you have left over before you pay your taxes? So that's price over EBIT, 24.98. You can see that's above. Price over EBITDA, same thing, except that includes depreciation and amortization. So earnings before interest, taxes, depreciation, amortization. So price over EBITDA at 17.65. These are the 3-year and 5-year historicals, 12.95, 12.15. So you can see here, well above it. And then price over operating income. This is just looking at the income that's coming directly from its core business, its operating business. Okay, so it's not including any type of income that they made from sale of an asset or an investment that's not related to its core business, such as Bitcoin or whatever investments that they made. That wouldn't include that. That's just coming from its core business. So if you're a car manufacturer and that's your core business, then it's only including income from the sale of cars. Okay, so that's 26.65. Again, we're well above that. 3-year average 19.15, 5-year average 18.05. So here on the surface, it looks like the valuations are rich based on historical means, but we do have that stimulus that could be justifying it. All right, and that's how the market's valuing it right now. Gross profit margins, same idea. So remember, this is for the S&P 500. We could use that as benchmarks. So gross profit margins 32.7, and those are pretty much in line with the historical averages. Gross margins, that's whatever you sold a good for, how much did it cost you to make that good? You have left over a profit, that's 32.7. Okay, net margins and operating margins, EBITDA, same idea here, except then you're taking out more expenses, because besides the cost of producing the good, you'll have other expenses, right? Like marketing expenses, offices, with investor relations and maybe other secretaries, all those others that don't go directly into producing the product. You're going to have other expenses, research and development, deduct that, and then you got other profit margins. Okay, so here it looks to me that we are kind of in line, maybe even slightly better on the gross margins and EBITDA margins, slightly better, maybe slightly off on the operating margin, but really like kind of in line with those historicals. We could also look at financials, like debt to equity. So if the debt is really increasing relative to how much equity we have, we'd see this number increasing. Here we're in line. Debt to cash, this one actually has improved. So basically the amount of cash we have relative to the amount of debt right now, that looks like improved, because remember, our cash went up, right? Cash reserves went up. Debt to EBITDA, that looks to me like it's kind of in line, maybe a little bit worse than historicals. So any questions so far, Will?
No, we're good, D.
All right. So the yields, how do we take a look? How do we, look at the yields here? And the yields is kind of like when I described the cap rate, right? So the cap rate would be on a real estate. Well, if I'm making $10,000 in income, rental income, it costs me $100,000 to buy. That's like 10% return per year, right? So that's how an earnings yield would look. Well, if I took my net earnings and divided it by what it cost me to buy all the stock, so now I own all the companies outright. How much am I yielding? 3.1%. So you can see that's below the 3-year and 5-year benchmarks. Part of that's also we're at 0% interest rates, so it's much cheaper to borrow money, right? Much easier to raise capital. So the yield, the returns are reflecting that, right? So that's what we're seeing here. As interest rates, as the risk-free rate goes down, this is expected to go down as well. EBIT, earnings before interest and taxes yield, 4%. Again, that's below these benchmarks. EBITDA, 5.7%. So That compares to 8% 3-year average, 8.4%. And then operating yield, that's just income from our core operations, 3.8% versus 5.4% and 5.7%. And you're probably going to see same thing in other assets, right? Like, I don't know, Will, what do you see as far as rental properties? Because you like doing that. Are the returns or cap rates going down as you
look at them? To be honest,
Huh?
the returns are so light that it's hard to even look at them anymore. You know,
Right.
it's like
Because the rental income may have stayed the same, maybe went up a little bit, but the prices went up a lot, right? Because now people who can borrow at cheaper rates are paying higher prices for the assets, right? So if you're paying higher prices for the assets and the rental income is the same, then your cap rate is moving lower. And that's what's happening. Is that correct, Will?
big asset chase.
It's a big asset chase, and that's kind of what we're seeing here in the S&P 500. So let's take a look at, well, how much, theoretically, how much over are we paying above the historical benchmarks? Like how much did we climb up, right? So we see here the yields, how much less we're getting, right? If we compare 5.4, 3.8, 1.6%. around, here net earnings about 1% lower than the historical. So how much over are we paying the historical mean? Let's say everything just kind of reverted back, right? Like interest rates just went back up, no more stimulus, whatever. How much are we paying over, giving that compensation right now for future growth, right? That's what we kind of want to estimate. What are we paying over for that future growth? So here we see, if we use the 3-year average as our benchmark, here's the PE ratio, there's a 3-year average. That means that we are paying right now 27% higher. So think of it, if you're buying a house and now you're expecting that the rental income is going to go up in the future, how much are you paying more for it than you would have? 27% more. If we use the price to sales as our benchmark, and we looked at it and said, well, how much are we paying higher? 37%. Price to book, price to operating income, same idea. So here, if we took the average of these valuation ratios based on historical means, right now the market is given a 33% premium, okay, from historical averages, based on, that there's going to be based on lower interest rates and the Fed stimulus, maybe people coming out of COVID. So we're going to see some pent up demand and growth. And that's how much the market right now is compensating over historical benchmarks. Does that make sense to people?
Yeah, it does.
Okay. So that's kind of like, where you're looking at. Now, if it's wrong, it doesn't pan out, you kind of see how much air there's in there, but maybe it could grow even faster, so at least you have a sense. So let's take a look at how much the market cap grew and how much so far the total revenue, net income, and so forth. So we see that the total market cap in last year grew 34%. On 3 years average, year over year 16%, 5-year average 15.2. So last year it grew by a very healthy amount, right, relative to historical levels. So last year is the bulk of that growth. And remember this, 356, it's not going to add up to exactly 378 market cap, because we are excluding some companies which, if we're not getting all the data that we need, if they're missing some data like out of here, we're just going to exclude those for now, just so we could, get a better sample. So 34%. Well, during the same period, actually revenue went down 1.8%. So we see that so far the revenue is not totally there. A lot of companies in S&P 500 haven't done well. Some have, some haven't. But we see on net they haven't done well so far, but the market thinks it's going to. So in total revenue, we didn't see the growth, that we've seen in the last 3 and 5 years. Net income did grow by a lot, 25%. So they were able to, on the same revenue, make more income, and that could have also been from investments in stuff where they improved their margins, cut costs, whatever it is. The net income looks pretty good there, up 25%. Operating revenue, that's coming from their core business, down 1.6%. Operating income up 4%. You see gross profits up 2.2%, and so on. So we're right at 9:30. I'm going to stop here, but maybe we'll continue tomorrow to say, okay, now that we have our benchmarks, let's take stocks, individual stocks, and start comparing it to that. So if there are no questions, Will, I'm going to stop right there.
Nice job, D. Makes me wonder whatever happens if interest rates ever tick up in the slightest.
Right. Well, if interest rates, if interest rates kind of come back to the 3-year average, 5-year average, and if the stimulus, doesn't pan out, with the spending, and if we got, maybe the pent up demand from the coronavirus, if it goes away, you'll see how much approximately, how much is in there, right now priced in, right? So all those things right now are being priced in into the market. So we'll see. I mean, I think we're still even working on the stimulus, right? It still has to pass.
Yeah, well, this previous stimulus money hasn't even been spent. So yeah,
right, and there have been and we've had already stimulus checks come out. We've had stimulus have passed and come out. But remember, it takes it takes time to work its way through the economy, right? So it's not like day one. It takes time for that to work its way through the economy. So we didn't feel the full effects of it yet.
Yeah, very cool, D. Thanks so much, buddy.
All right. Thanks, everyone, for joining. Stay safe out there. Have a good trading day, and hope to see you guys tomorrow.
All right, chameleons. Great job, D. Thanks so much. Have a great day. Remember, thumbs up, always appreciated. Have a great trading day from space, everyone. Bye-bye.